Dear FR students, let's start. Pre-scene mock and your attempt is March 2026. We will be discussing this ACCA pre-scene mock. Along with that, I will be giving you the examination tips as well. And towards the end of today's class, there will be one very important announcement as well. So let's just start from our very first question, section A. Which of the following statement regarding IASB due process is correct? Now, first of all, before reading all the options, let me tell you one thing, students. While sitting in exam, if you have no idea about the question like this, first of all, please don't get confused. There's no need to go into a panic state. Why? Actually, when you go into a panic state, then obviously the rest of the paper, which actually based on your main core area of the syllabus, where normally students, they perform very good. But once you put yourself in a panic position, once you start taking the pressure of the one question only, which you don't know, then you end up by making, I would say, countless mistakes. So there are a number of reasons of failure. One of them is students at a very high, FR is a higher level, professional, you people are professional students. Even a student doesn't know even one question, that student starts panicking. And that is the moment then it becomes difficult to, come again to that proper state of mind where you can properly answer the questions. So first step is, if you don't know something, be relaxed, be calm. You are not the only one. Number one. Number two, you just need to get 50 marks in order to pass the paper, which means that you can still make 50% mistake. I'm not saying that go there and make 50% mistakes, but I'm just telling you, even you don't know something, that 1, 2, 3 question, if you don't know, they will not make you fail the paper. So let's start now the first question. Which one of the following statement regarding IASB due process is correct? Okay. One by one. Publishing a discussion paper is a mandatory step that must precede the ED. That statement is false. Why? Basically, publishing the discussion paper is not a mandatory step. Okay. Publishing exposure draft for public comment is not a mandatory step in due process. Now, the second option is also false. Why? Because ED, exposure draft, is a mandatory step. Basically, what happens before going towards the final IAS or IFRS, you prepare ED, then it's a mandatory step. You have to give that to the public, and then you'll be waiting for the public response as well. Normally, you have to give them 60 days. So point number 2 is a mandatory step, and you are saying it's not mandatory. That's why it is also false. ED is exposed to for public comments. Yes. For a minimum period, no. Instead of 90, it is 60. That is why it is also false. So we are left with only one option. At least 9 out of 14 members of IASB must approve the new IFRS accounting standard before publishing. True. Now I'll tell you one thing. Even the question like this, if you have no clue at all that which one is the correct option, is still, even you go for a fluke, you have 25% chance that your fluke could be correct. I'm not saying 100%, but still you have a 25% chance that your fluke could be correct. So I would again say the same thing. Do not go into a panic state if you don't know 1 or 2 questions. Not knowing 1 or 2 questions cannot make you fail. Okay. Which one of the following statement is correct? An entity does not prepare its financial statement in accordance with IFRS accounting standards. There is an organization, they're not following IFRS accounting standards. The entity wishes to prepare sustainability related financial disclosures. IFRS S1, S2, okay. The entity is prohibited from applying. No, you are not. That's false. Why would you prohibit? Let's say I'm a private organization. I'm not following all the ISS and IFRS, and I'm not required as well. If I want to go and apply sustainability, I want to disclose something according to the sustainability related financial disclosure I want to give. So why you will prohibit this for me? So that's false. Entity must prepare its financial statement in accordance with IFRS accounting standard if it wishes. That is also false. Why? Basically, if you're going for IFRS S1, S2, which they relate to sustainability, it is not necessary that first I'll be preparing all my financial statements according to the standards. Not necessary at all. In fact, for example, I'm not applying all the ISS and IFRS. Of course, there could be a reason like I'm a private company, but I still want to disclose and give the disclosure relating to the sustainability. So obviously that will help my user of financial statements. They should be happy. Entity may apply IFRS sustainability disclosure standard regardless of the fact that its financial statement are not prepared. That is suitable. True. An entity financial statement are not prepared in accordance with IFRS accounting standard, it must secure approval. Come on. Come on. I don't need any approval from IASB before following this sustainability standards. Where's my calculator? Okay, it's here. What is the interest expense for the year end now, student? Now, look at this. What is the interest expense 30th September X5 in accordance with IFRS and financial instrument? This MCQs is on your pure syllabus, the core syllabus. Here, of course, you should not be making mistakes. Like students, you should be very good in all the, you should be having a very strong understanding of, I would say, all the ISS, IFRSs, ratio analysis, obviously consolidation, final accounts. When it comes to IFRS 18, which has replaced IAS1, you should be very good in that as well. You should be good in sustainability standards. And obviously, you should be having a good grip on conceptual IASB framework also. That is the main area, core area of your syllabus. Here, obviously, if you are making mistake, it means you do not have a good preparation. So at least whatever is the core area of your syllabus, you should be having a very good command on that. Like now the question is, this MCQs is on IFRS 9. So all the ISS, all the IFRSs, you should be having a very good grip. What they are asking, this is also very important to understand the question. What is the interest expense? You just need to tell us the interest expense. Year end is September X5 in accordance with IFRS 9. Nothing else. Only the interest expense which goes to income statement. That's it. October X4, start of the year, Acca issued 7% loan note for their nominal value 3 million. Nominal value means par value. 7% is the coupon rate, cash interest rate. Issue costs are 2% of the nominal value. Interest is payable in arrear. At the end of each year, we pay interest. The loan notes are repayable at a premium after 5 years. Effective rate of interest is 10.94% per annum. Now, listen to me carefully. Acca issued 7% loan note. When my company is issuing the 7% loan note, number one, it's a financial liability. Number two, when we say financial liability, then according to IFRS 9, there are two possible classifications. One is fair value through P&L, another is amortized cost. According to IFRS 9, financial liabilities, there are two possible classifications. One is fair value through P&L, another is amortized cost. Now listen to me carefully. It is also written in IFRS 9 that most of the financial liabilities of the organization, for them, the suitable category is amortized cost. Plus, in exam, if financial liability information is given and nothing is mentioned, I will always go for amortized cost category. There is a default classification if nothing is mentioned. I'll go for amortized cost category. Let me give you the example of another default classification. For example, let's talk about financial asset, investment in equity instrument. If my company has made the investment in equity instrument, then of course, investment in equity instrument, I have two possible classification: fair value through P&L, another is fair value through OCI. Now listen to me carefully, students. If my organization, they have made investment in an equity instrument. Simply we bought ordinary shares of XYZ company. Obviously for us, it is a financial asset because we have invested. According to IFRS 9, there are two possible classification. One is fair value through P&L, another is fair value through OCI. Now listen to me carefully. The default category, when I'm making investment in equity instrument, the default category is fair value through P&L. I'm solving a question in exam and examiner has just mentioned one thing, that my company for which I'm solving the question, they have invested in an equity instrument of XYZ company. And after that, examiner has not mentioned that either which classification it will go. Nothing is mentioned. The default classification for investment in equity instrument is fair value through P&L. In order to follow fair value through OCI category in case of investment in equity instrument, number one, that investment should not be for a short-term trading purposes, because when your investment is for a short-term trading purposes, then it must go to fair value through P&L category. Number one, if I want to keep that investment in equity instrument I want to classify that under fair value through OCI. Number one, my investment should not be for a short-term trading purposes. And second, my company will have to make an irrevocable election. Once you have made an irrevocable election, only then you can go for fair value through OCI. So in case of investment in equity instrument, the default classification is fair value through P&L. OCI is only possible. Number one, your investment should not be for a trading purposes. Second, you have to make an irrevocable election. Now let's talk about financial liabilities, because our question is on financial liabilities. There are two possible classification for the financial liabilities. One is fair value through P&L, another is amortized cost. But according to IFRS 9, most of organizations' financial liabilities, for them, the suitable classification is amortized cost. And default classification for financial liabilities, amortized cost, if nothing is mentioned. So of course, here examiner has not mentioned the P&L category or amortized cost category. So number one, nothing is mentioned. It's a financial liability. I'll go for amortized cost category. Now I'll be thinking, what is first? You need to decide the classification. If you just directly jump and just do whatever and just calculating the interest expense, you will not get marks. Someone who is unable to identify the classification, so obviously you will be making an error. You won't be able to give the correct answer. It is amortized cost. Number one, under amortized cost, transaction cost. In case of financial liability, amortized cost category, transaction cost is deducted from the financial liability. Second, interest expense which we take to P&L, which we charge to P&L, it is always on the basis of effective rate. Under amortized cost category, interest expense which we charge to the P&L, that is always on the basis of effective rate, which is 10.94% here. Now, and one more thing. What is the interest expense? Now they have written here dollars. They're not mentioning, ignore 3 zeros. They're not mentioning millions. It means I have to take all the values. First of all, 3 million. Issue cost is 2%, which will be deducted. 3 million. If I take 2% of that, I'm getting 60,000. Kindly check. Let me check also. We should not be making any arithmetic errors. 60 is. From 3 million, I'll deduct this 60,000. 2.94 million. Now 10.94% will be applied on this 2.94 million. That is finance cost, interest expense, 10.94%. Let's take students. I'm getting 3,21,636. So logically, this is my answer. Examiner has not asked us the carrying amount of the loan. If the question was what is the carrying amount of the loan, then obviously this will be added. And then we would have deducted cash interest. Cash interest is always paid on the basis of par value. Cash paid or cash interest paid, which they are not asking here, 7% on this 3 million. If you take 7% of 3 million, I'm getting 2,10,000. You will get the carrying amount. Of course, they're not asking the carrying amount. I'm just giving you the idea. If the question was on carrying amount, then obviously the double entry of finance cost 3,21,636. The double entry is finance cost debit by 3,21,636 and financial liability credited by 3,21,636. Double entry of cash interest payment is financial liability debited by 2,10,000 and cash or bank will be credited by 2,10,000. Right now, the answer is 3,21,636. But I've also given you the explanation of other areas relating to this question. Okay, let's go ahead. Now, student, just see one thing before we attempt this question. Try to understand how the pre-seen FR mock started. A very first two questions, I would say they were unusual questions. Majority of the student, I believe they wouldn't be in a position to answer the first two MCQs. The whole objective is to ask the student at a very start unusual question for which majority of the student they don't have the answer, they're not prepared for that, let's say. So psychologically you get the pressure. Then even though the remaining entire paper is on your main area and where you do have a very good preparation, but since you have taken the pressure of the first two questions, then automatically you will be making, I would say, numerous mistakes, multiple mistakes in rest of the paper. So when you are attempting a paper like FR and you see there are a few questions where you have no idea at all, kindly don't go into a panic condition. Which of the following statement is correct? H company measures its investment property using fair value model. Stop. IAS 40 fair value model. We know that under IAS 40 fair value model, whatever the change in the fair value comes, that goes to P&L plus IAS 40 investment property fair value model, we do not depreciate. At the end of each year, we see what is the fair value difference goes to the P&L. H company measures its investment properties using fair value model on 1st July X5. It transferred an investment property to owner occupied property. What is happening? There's a transfer from IAS 40 to IAS 16. There's a conversion. Basically, they're converting investment property to an owner occupied property. On our owner occupied property, obviously we apply IAS 16. Okay. The property had cost 5 lakh, but cost is not relevant for me because you are not following cost model, you're following fair value model. Carrying amount is 7 lakh 50. And when I'm transferring the property, I'm transferring the property on 1st July X5. The fair value at 1st July X5 is 8 lakh. First of all, carrying amount of the property is 7 lakh 50. The day we are transferring investment property to IAS 16, property, plant and equipment, on that day, the fair value is 8 lakh. Now listen to me carefully. Immediately before transferring your investment property to IAS 16, you have to remeasure the fair value of investment property. And whatever the change in the fair value comes, on that change, I will apply IAS 40. So here is a difference between these two fair values, 50,000, and under IAS 40, the change in the fair value will go to P&L. Number two, under IAS 16, owner occupied property will have the value of 800,000. Now let me repeat. First of all, when you are changing. You are coming from IAS 40 to IAS 16. Just immediately before transferring your investment property to IAS 16, you need to check what is the fair value. The day I'm converting investment property to IAS 16, you have to remeasure the fair value difference. Will go to IAS, will go to P&L by using IAS 40. And 800,000, the carrying amount, this carrying amount actually becomes the carrying amount for property, plant and equipment under IAS 16. This is what you need to do. This is reclassification when we are coming from one IAS to another IAS. Let's see what are the options. Which of the following statement is correct? On 1st July X5, the property is remeasured to 8 lakh, which makes sense. 50,000 gain is students. Actually, OCI issue would have come if company was initially following IAS 16 revaluation model. Then, of course, 50,000 we would have taken to OCI. But right now, we are coming from 40 to 16. We are not coming from 16 to 40. That is why this is incorrect. Difference should go to P&L rather than OCI. The investment property is transferred to owner occupied property. No, false. As I just mentioned, immediately before transferring your investment property to IAS 16 owner occupied property, you need to remeasure the fair value. You cannot transfer at 750. On July X5, the property is remeasured 8 lakh to 8 lakh. Yes. 50,000 gain is recognized to P&L. Yes. The deemed cost of owner occupied property is perfect. This is what we have already decided also. Let's see the last one. This is a change in accounting policy and should be applied retrospectively. The property is transferred at its original cost 5 lakh less accumulated. No. There's no such thing at all. This is absolutely incorrect. Why this is absolutely incorrect? Because it's not a change in accounting policy at all. Actually, now let me tell you what is accounting policy. Actually, accounting policy means where we have the right to choose. Accounting policy means which gives you the option. Either choose option 1, option 2. Examples of accounting policies. IAS 40 investment property. IAS 40 gives you two options, either to follow cost model or fair value model. That is an example of accounting policy. You will be choosing one of them. But obviously, we know that as far as investment property is concerned, fair value model makes more sense. But that is an example of accounting policy that IAS 40 gives you two options. Another example of accounting policy, IAS 16 property, plant and equipment gives you two options. One is cost model, another is revaluation model. Whichever you want to choose, you can choose. That is accounting policy. Here, actually, it is not accounting policy. I'm coming from investment property to IAS 16. It means the way I was using that investment property, the usage has been changed. Assuming earlier I have given that property on rent, I was generating rental income. Now I have decided to empty that, simply vacate that property and bring my entire business team to that property, and I'll be using that property, let's say, like my office. So the point is, here's a change in the usage of that asset, and I'm coming from one IAS to another IAS. It is not change in accounting policy. It is not something that someone has given me the option, either do that or this. This is basically why it is happening. It is happening because change of my business environment. So it's not a change in accounting policy. And always remember one concept, students. If someone asks you, what do you mean by accounting policy? Actually, accounting policy means where you have a right to choose. Here, I do not have any right to choose. If I'm coming from 40 to 16, what exactly IAS 40 says, I have to follow that. What rule IAS says, I have to follow that. I don't have any option. Okay. By looking this exchange rate, at least IAS 21, foreign currency transaction should come in your mind. Which of the following amounts should be reported in beta? Company's financial statements for the year ended 30th September X5. Now read it again. Which of the following amounts, so it's going to be more than one, should be reported in beta company's financial statements? When they are saying financial statement, not mentioning either should I go for SOFP or should I go for income statement, then I'll be thinking for both of them. Plus choices, given option will also guide you. If you see the option, they are giving me exchange gain and payables. When we say trade payable, I should be thinking for SOFP, and exchange gain or loss, I should be thinking for P&L. Because they are not categorically writing in the requirement that should I be just thinking for the P&L or SOFP. They're saying financial statements. I'll be thinking for both of them. Plus look at the options also. Okay. And they don't forget the year end is September X5. Beta company uses dollar as its functional currency. So dollar is a functional currency. According to IAS 21, other than functional currency, other than functional, whatever currency you are having other than functional, that's a foreign currency for you. Beta company uses dollar as its functional currency on 10th August X5. Beta company purchased goods on credit for euro 1.5 million. 10th August 2000 X5. They bought goods on credit and the amount is euro 1.5 million. Logically, 10 August 2015, the double entry is purchases debit and trade payable. Correct. Of course, our functional currency is dollar. So first of all, student, we need to convert this 1.5 million into dollar. Then we will read the rest of the information. Look at the exchange rates are as follows. 10 August X5. Euro 1 is to dollar 1.25. Student, first of all, you should be able to understand which currency is strong and which is weaker. Logically, 1 euro is equal to dollar 1.25. So we can easily decide euro is a stronger currency here as compared to dollar. Why I'm saying euro is a strengthened currency, euro is a stronger currency than dollar. 1 euro is equal to 1.25 dollars. Look at the ratio. 1 euro is equal to more than $1. So since 1 euro is equal to more than $1, that is why we are saying euro is stronger than dollar. Okay. Now another point, we will be converting, and the dollar is our functional currency. We'll be converting euro to dollar. Euro is a stronger currency, and I'll be converting a stronger currency to the weaker currency. Students, when we convert stronger currency to the weaker currency, whatever amount is given to you in the stronger currency, when you will be converting that into the weaker currency, your answer should be more than that. Logically, when we'll be converting 1.5 million euro to the dollars, answer must be more than 1.5 million. How much more is not the concept. It has to be more than 1.5 million. Why it has to be more than 1.5 million? Because we are converting stronger currency to the weaker currency. Okay. Now the question is, should I multiply 1.5 million euro with 1.25 or divide? Now listen, we have decided dollar is weak, euro is stronger. We are converting strong currency to the weak, and whatever amount is given to us in the stronger currency, when I will be converting that into a weaker currency, so amount has to be, the final answer has to be more than 1.5 million. It is only possible when you multiply that with 1.25. If you divide, so obviously you will not get the, then your answer will be even less than 1.5 million, which makes no sense. And let me just give you one more idea. Either you need to multiply or divide. That might help you more. Whenever exchange rates are given, exchange rates are always given in the form of quote. One is direct quote. In case of direct quote, numerator will have a local currency sign and denominator will have a foreign currency sign. And whenever you are facing a direct quote question, rule of translation is multiplication. You need to multiply. But student, how will you decide? Is it a direct quote or indirect quote? Direct quote, local currency exchange rate sign. Local currency sign will be in the numerator and foreign currency sign will be in the denominator. Like in our country, what happens? We write the exchange rate like this, rupees per dollar. That is our local currency. Dollar is for us foreign currency, so we multiply. Then I'll come to the question also, don't worry. There's one more, which is indirect quote. How will you decide indirect quote? Opposite of direct quote. Foreign currency sign will be in the numerator and local currency sign will be in the denominator. Now for translating, we need to divide. Now the question is sir, they have not given us the exchange rate sign like numerator and denominator. So let me make that easy for you. If you are not good at dealing with the ratios and you're not good in dealing with which currency is strong and weak, and you want to follow direct or indirect quote, whenever this one always comes in the denominator. One always comes in the denominator. If one always comes in the denominator, then how will you write? I'll write 1.25 upon euro 1. Dollar is my local currency, euro is a foreign currency, direct quote. And direct quote rule of translation is multiplication. So if you have not been given exactly numerator and denominator, then you need to know one thing. One always comes in the denominator. So this is a direct quote. It means they have given you the ratio as well as technically it's a direct quote. And in case of direct quote, the rule of translation is multiplication. Now it is up to you. Either you go with the ratio, weaker or stronger currency, or direct or indirect quote. If it is, in case of indirect quote, we divide. In case of direct quote, we multiply. Now here, we will multiply this 1.5 million with 1.25. Let's see how many dollars we are getting. Students, I'm getting $1,875,000. Okay. This is happening on a day of transaction, the day we purchased goods. Okay. This is 10th August. Of course, the day the transaction occurs, on that day there will be no exchange, there will be no exchange, no gain or loss. On settlement, there will be exchange gain or loss. On 10th September X5, Beta company paid 50% of the invoice amount. Now stop. 10th September, exactly after 1 month, Beta company has paid 50% of the amount. Trade payable, we have recorded 1.875 million. 50% of that we have paid. It means, let me make the double entry. Trade payable debit. If I have paid 50%, keep watching. I'm taking 50% of this. I'm getting debit is 9,37,500. Now I have to see the bank payment. Of course, the day I'm making the payment, it is 10 September X5. On 10 September X5, obviously the exchange rate is going to be different. On 10 September X5, students, the exchange rate is $1 is now equal to 1.23. How much liability we have paid? 50% of the trade payable we have paid. Now listen, let's check the cash outflow. How much we have paid? 50% of our liability. Total liability in euro is 1.5 million. 50% of that we have paid on 10th September. On that date, exchange rate was 1.23. This will give us the cash outflow. I'm getting, students, 9,22,500. Let me recheck so that we should not be making any arithmetic error, which normally we do not. Okay, now 9,22,500. Now, student, you can see one thing. Your liability is debited by more amount than your actual cash payment. Means we paid less, but the liability is reduced with the more amount. So logically, I'm having gain, exchange gain. Why exchange gain? Because the liability which I have paid is 9,37,500, but actual my cash outflow is only 9,22,500. So the difference is exchange gain. Let's see the exchange gain. Difference of these two, 937,500. Students, I'm getting exchange gain 15,000. Okay. We have paid only 50% and still 50% liabilities left. According to the terms of the contract, balance would be payable on 10th October X5. Of course, the year end is September X5 for which we are working. Alpha's year end is September 5. And they are saying work for 30th September X5. Now listen to me carefully, students. Initially, you had a trade payable liability in euro 1.5 million, but out of that 1.5 million, we have paid 50%. But 50% liability is still there. Now listen to me. Trade payable is a monetary liability. According to IAS 21, monetary items, monetary asset and liabilities, they are retranslated on each SOFP date by using closing rate. Closing rate is the exchange rate on SOFP date. And whatever the exchange gain or loss comes, that goes to P&L. Repeat, we still have a half of the trade payable, which is a monetary liability. So we have to retranslate that. So let's see. What is the now exchange rate on 30th September is 1.26. So we have to retranslate the 50% remaining liability. 30th September 2000 X5. Let's see what is the trade payable amount. Initially, it was euro 1.5 million, but 50% of that we have paid. Still 50% is left. And now the exchange rate is 1.26. Calculator. Students, I'm getting 9,45,000. Now listen to me carefully. Trade payable we have converted on transaction date. On transaction date, the amount was in dollar, it was 1.875000, but out of that 50% we have paid. It means 50% is still left. Now that 50% amount at year end is 945. But in our books, what is the value? In our books, the value is 9,375,000. So you can see that liabilities increase. The trade payable is increased by the difference of these two. Rise in the payable, rise in the liability is exchange loss. Is an exchange loss. Students, I'm getting an exchange loss of 7,500. The double entry will be, we will debit the exchange loss. Debiting exchange loss means exchange loss, my bad. We will debit the exchange loss. Exchange loss is debited by 7,500 and trade payable will be credited. Liability will increase. Logically, in SOFP, the trade payable amount will be 9,45,000. Exchange gain is 15, which goes to P&L. Exchange loss is 7,500, goes to P&L. So net exchange gain, which goes to P&L, is 7,500. Net exchange gain. And trade payable closing amount will be 9,45,000 in dollars. Let's see the option. Student, net exchange gain is 7,500 and foreign trade payable is this. Beta is the answer, and I strongly believe I have not just solved this question with you, I've given you almost a revision of IAS 21 as well in a very short period of time. Let's move ahead. Okay. Let's see. According to IASB conceptual framework for financial reporting 2018, which of the following fundamental characteristics faithful representation of an economic phenomena? When we say faithful, it must be complete. It should not be biased, neutral. It should be free of errors. uh, Neutral, free of error is correct, but what about the prudent? It has nothing, prudent has nothing to do with the conceptual framework. Okay. And it says complete, complete makes sense, relevant and verifiable. When you are saying relevant and verifiable, complete makes sense. It should be actually complete and free of errors and unbiased. So you're not mentioning unbiased. Complete, neutral, free of errors. Again, I would say a question which could make trouble the students, but kindly listen to me carefully. Again, even you make mistake in this question, no issue at all. You still have enough questions to answer and get easily more than 50% marks. You can easily cross that 50 marks line if you are little bit patient and your mind is properly working, then don't worry at all, you can easily answer. On 15 March X5, Latte Company, Latte, it's a coffee company, is finalizing its financial statement for the year ended 31st December X4. Which of the following accounting treatments apply to events after reporting period is not correct? In accordance with IAS 10, students, IAS 10, events after the reporting period but before authorization of financial statements, we apply IAS 10. There are two types of events. One is adjusting and another is non-adjusting. Of course, in case of adjusting events, you have to adjust your financial statements. Non-adjusting events, if they are material, you need to disclose. Adjusting event means on SOFP date, evidence of that event was there. Only the confirmation comes after the reporting date before the authorization of financial statement. Such an event is an adjusting event. For example, on SOFP date, you had the information that one of your customers is going to be bankrupt and confirmation comes after the reporting date. It's an adjusting event because you knew on SOFP date. But theft of a stock, fire of a stock, they are non-adjusting event because on SOFP date we had no idea about these events. And when these events are, I would say, material, you need to disclose non-adjusting events. Let's see. Receivable at 31st December X4 included the full amount due from customer. The customer entered bankruptcy on 10 Feb X5 after several months of difficult trading. In the financial statement, later company has written down the amount receivable from the customer to the expected recoverable amount. Look at this. Read it again what they are saying. Which is not correct. Can I say this one is correct? It's an adjusting event and you are doing it. Receivable December X5 included the full amount due from customer, the customer bankrupt. Normally on SOFP date, you do have the information like that. 10th Feb X5, you got the information and finally you decided to write down the receivable amount to the expected recoverable amount. That is true. We need to find out which one is not correct. A property was measured at 4.5 million at December X4. In Fab X5, the property met the condition to be classified. Held for sale for its fair value as cost to sell was determined 4.2 million. In financial man later has adjusted the carrying amount to 4.2 million. That is incorrect. Why it is incorrect? Because it's non-adjusting event. It's not an adjusting event. Due to non-adjusting event, you cannot adjust your books. Read it again. Whoever remembers the few examples of adjusting and non-adjusting events could easily spotted this point. A property was measured at 4.5 million this summer. In Fab X5, property met. So the conditions of IFRS 5, they were not met on SOFP date. They were met after SOFP date. They were met after the reporting date. So it's a non-adjusting event. It's not an adjusting event. A plan to discontinue a major division of later was announced to employee on 20th January X5. In the financial event, later has disclosed the plan as a non-existing event, but it has not recognized what? A restructuring provision. So everything is fine. Look at this. A plan to discontinue a major division letter was announced. If you recall a little bit, I would say IAS 37. When do we make provision for the restructuring? We make provision for the restructuring when, according to IAS 37, the criteria is met. And for the restructuring, number one, within that criteria, number one point is a public announcement to the key stakeholders. Key stakeholders are employees, they are working over there and they will be affected by restructuring. Second, your customers, suppliers. You need to inform them. Announcement. And this another point is there should be a proper approval from the BOD. There should be a proper formal plan approved by BOD. Only then you can make provision under IAS 37 for the restructuring. Now let's read this. A plan to discontinue a major division letter was announced to the employees. That division on 20th January X5 we have announced. In the financial later has disclosed the plan. And it's a non-existing event. Why is a non-existing event? Because it is not happening on the reporting date. It is happening after the reporting date. And we had no idea something will happen after the reporting date. It's a non-existing event. You have treated non-existing event like a non-existing event. So again, it is properly correct. We are here to find out. Not correct. We have found one. Liabilities at December X4 included an estimated accrual 1.2 million in relation to profit related bonus payable to later employees. Okay. The amount of the bonus was finalized. 1.34 million January X5. In the financial statement, it was adjusted. Again, it makes sense. Because on December, the value was 1.2, which was not the final value. Final value comes after the year end, but before the authorization of financial statements, and you adjust your books. Again, it's a true statement. Only the one statement is incorrect, which is B. And here, the question says the find out incorrect statement. Okay. What amount of borrowing cost, IUS 23, should be capitalized during the December X5? Silver Leaf Company had the following general loans. Student, whenever general loans are given, so you should be thinking for general borrowing. In case of general borrowing, first you need to calculate a rate of capitalization. General loans outstanding throughout the year, December X5, 40 million, 11% repayable, X8, 20 million. Okay. First of all, let me calculate rate of capitalization. Rate of capitalization, ROC is rate of capitalization is equal to interest. If I take 40% of 11% of 40 million, I'm getting 4.4 million. 8% of 20 million, I'm getting 1.6 divided by 60 into 100. Let's see what percentage we are getting. Students, I'm getting 10%. So rate of capitalization is 10%. Now simply you need to do one thing. Now we need to just find out when the expenditure incurred. Let's see. On 1st Feb X5, Silver Leaf Company began construction. So construction started on 1st Feb X5 on a new retail store. It immediately withdraw 12 million to the general loan money to fund this. On 1st March X5, it withdrew further 8 million. The retail store was completed 30th September X5. So when retail store was completed on 30th September X5, maximum capitalization can be till 30th November X5. But was not open until, what not open, that is something else. But the point is, general retail store was completed, the construction was completed, your qualifying asset was completed on 30th November X5. So maximum we can capitalize till 30th November X5. How will we calculate the capitalization amount? It's very simple. First 1st Feb we started the construction. From here till 30th November we spent 12 million. Take 10% of that and multiply by months. How many months are there? If you count the time period, I'm getting 10 months out of 12. Calculator. I'm getting 1 million if I'm not wrong. 8 million was spent on 1st March. After just 1 month. So the time period will be 9 months now. That gives me 6 lakh. So students' borrowing cost capitalized is 1.6 million. Borrowing cost capitalized is 1.6 million. IAS 23 general borrowing. Okay. What interest expense should Star Company recognize for the year ended X5 in relation to power plant? Read the question again. One, you just need to calculate, tell us interest expense. But for the year ended, relating to power plant. January X4, 2 years back. Star Company completed the construction of power plant, has an estimated useful life 20 years. Star Company immediately started to use the power plant. Star Company is required by law to restore the site on which the plant is built at the end of useful life. At 1st January X4, the estimated cost of dismantling the plant and restore site after 20 years was 5 million. If you recall, then such dismantling and restoration cost under IAS 37, first we calculate present value of that, and the double entry of the present value is property, plant and equipment debit, provision credit. Then subsequently, due to unwinding of discount, the value of the provision will increase and finance cost will also increases. The cost of capital for Star is estimated 8.5%. Present value factor they have given us 0.916. So first of all, 1st January X4, if I calculate present value of this 5 million. Let me see what I'm getting. Students, I'm getting 9,80,000. Logically, the double entry of this 9,80,000 is property, plant and equipment debit by 9,80,000. We will credit the provision by 980. Property, plant and equipment debited by 980, provision credit. Of course, they're not asking you what expense you will charge to the P&L. So you should not be thinking for the depreciation of this 980. If you read the question is specifically asking one thing, and the name of that one thing is interest expense. Plus, they're not asking the interest expense on December X4. They're asking you that give us the interest expense on December X5, means the second year. Which means that December X4, due to unwinding of discount, this provision value will increase. What is the discount rate? 8.5%. If I take 0.085, I'm getting 83,300, but this 83,300 is due to unwinding of discount, and that is a finance cost, interest cost of X4. Look at the double entry. Interest expense on December X4 is debited by 83,300 and provision will be simply credited. But this is not our answer because examiner is not asking for X4. Examiner is asking us to calculate interest expense for X5. Now look at this, 980 provision credit, 83,300 provision credit. It means SOFP liability provision amount on December X4 will be 9,80,000 plus 83,300. Students, I'm getting 1063300. Now, very easily we can calculate December X5 interest amount. I'll take 8.5% of this. Students, I'm getting 90,380.5. So make it 381. Excuse me. Beta. Beta is the right choice. Of course, I would say a very easy area. Whenever students they prepare themselves for, I would say even IE16, you will definitely you have definitely seen the question on dismantling cost, calculating the present value, then unwinding of discount. It's a very common area. Normally, every student goes through such questions. So this question should not be creating trouble. What is the carrying amount of investment in Neural Labs company? Okay. In Quantum Innovations company's financial statement of financial position December X5, read it again. What is the carrying amount of investment in Neural Labs? In Quantum Innovations company's group statements. Let's see. July X5, December X5. Students, the time period is 6 months. Common area where student they make mistake, they don't count the months, they just directly deal with the figures, you will not get the right answer. Logically, the time period is of 6 months. Quantum Innovation acquired 25% equity interest in Neuro Labs. Now listen to me carefully. The post acquisition period is 6 months. Number one. Number two, whenever parent is having holding in another company and the range of that holding is normally between 20 to 50. Students, you recall, whenever parent is having the holding with a range of 20 to 50% in another company, normally that other company is an associate for us. And in case of associate, we follow equity method. Under equity method, you just need to calculate the carrying amount of investment in associate. How do we calculate? If you recall the format, we need cost of investment of parent. Then we simply add share in the post reserves of associate. Then we deduct if we are getting any dividend from associate. We also deduct if there is any impairment loss in our investment in associate. Let's see. Quantum Innovation Company acquired 25% equity interest in Neural Labs for 5 million. So the cost of investment is 5 million. We are just calculating investment in associate. Again, they're just written the dollars, no thousand, no million. So it means I'll be taking the complete values. Cost of investment. Student cost of investment is 5 million. Don't forget the post acquisition period is only 6 months. The investment provide Quantum with a significant influence. So significant influence means obviously associate over Neural Labs. Accordingly, the investment is accounted using equity method in accordance with IAS 28. Investment in associate and JV. At the acquisition date, the fair value Neural Labs identifiable net asset 18 million. For year end December X5, Neural Labs reported a profit after tax 8 lakh. Now stop. For the year ended, your associate has made the profit of 8 lakh, but this is the profit for the entire 12 months. Our post acquisition period is only 6 months. Read it again. For the year ended, for the whole year profit, for the 12 months profit is 8 lakh. We'll take the share at share in PAT. But look at this, 800,000, 25% of that but only 6 months. Why 6 months? The post acquisition period is 6 months. 8 lakh did not come in the post acquisition. 8 lakh is the profit for the 12 months. That is why we are just time apportioning and taking share in the 6 months profit, because our post acquisition period is only 6 months. Students, I am getting 1 lakh. Okay. Now 30th September X5 Neuro Labs revalued property. Recognize a gain of 300,000 in OCI. Student, please. There's a huge difference when your company generates a profit over 12 months. If I compare that with a fair value adjustment, they made the fair value adjustment on 30th September X5. On 30th September X5, your associate has recognized a gain of 3 lakh. This gain of 300,000 is not for the entire 12 months. Logically, technically, the gain of 3 lakh came in the post acquisition period. We are not supposed to time apportion this 3 lakh. Read it again. This event has happened on 30th September X5. On 30th September X5, which is a post acquisition period for me, Neural Labs revalued a property, recognized a gain of 3 lakhs. So simply the entire 300,000 gain came in the post acquisition period. 25% of that belongs to us. You will not time apportion that 3 lakh. So add share in gain. Why we time apportion 800,000 profit? Because that profit is for the 12 months. Let's take 25% of this. I think 75,000. If I'm not wrong, yes. On October X5, Neural Labs, your associate, paid a cash dividend 180 to its equity holders. When your associate gives you dividend, when your associate makes the dividend payment, the double entry is cash or bank debit and investment in associate credit. Of course, entire 180, we did not get it. We have 25% holding in that in our associate. So out of 180, our share is only 25%. Less dividend received 1,80,000. 25% of this, maybe 45. Yes, 45,000. So here comes the answer. 5 million. Oh, yes. 1 lakh plus 75,000 minus 45. 5.13 million. 5130000. Again, students, question like this, you should not be making mistakes. Common area of making mistake is some of the student, what do? They time apportion when they take the share in the gain of 3 lakh. It means you are making one mistake. It means you are unable to identify, you are unable to spot that 3 lakh is not for the entire year gain. The gain came only in the post acquisition period. Since the gain came in the post acquisition period, so 25% of 3 lakh belongs to parent. You are not supposed to time apportion this 3 lakh. Time apportioning 300,000 means simply you are just informing your marker that I'm unable to recognize it came in the post acquisition period. Obviously, your answer will be incorrect if you do that. Okay, students, let's see. Which of the CFO statement is are necessarily correct based on what? Current ratio. Let's see. Which of the CFO statement is are necessarily correct? The Apollo Trading Company has maintained a current ratio of 0.8:1. Current ratio means current asset upon current liabilities. 0.8:1 means you have $1 liability, but in order to pay $1 liability, you have got $0.8 assets. Your liability, your current liabilities are more than your current assets. For the last two reporting periods, industry is having one industry averages for $1 liability, they have got $1.2 assets. In the board meeting, the CFO made the following statements. Our short-term obligation exceeds our short-term resources. Can I say very true? Kindly reply, students. Yes or no? Okay. This ratio confirms that operating cash flows for the period was negative. I'm saying false. Current ratio does not give you the information. Current ratio does not mean that your operating cash flows for the period was negative. Not at all. It has none. It is not the indicator of giving you that your operating cash flows for the period are negative. There is a possibility that we are having a positive cash flows from our operating activities, and still we are having negative cash. Now the question is, sir, we are generating positive cash flows from our operating activities, and still we have a negative cash. How it is possible? It is possible if you have invested too much in your property, plant, and equipment. So there's a possibility you have utilized all the cash which you have generated from your operating activities, and even you have taken the loan as well. So technically, then you have a negative cash flow. But having a low current ratio does not mean your operating cash flow for the period they are negative. That is wrong. One is correct. So which means okay. Verdant Agrico operates a largest scale agriculture business. Indicate which IFRS accounting standard applies to each of the following asset held by Verdant Agrico by clicking on the relevant box in the table. Okay, fine. Item IS 41 16.2. Dairy cattle, of course, I'll apply IS 41. Fruit trees, students, fruit trees, I'll be using IS 16. Why I'll be using IS 16? If you recall, when we study IAS 41, within that IAS 41, we do discuss that on fruit trees, the fruits which you have, on those fruits, we will apply IAS 41 because those fruits are agriculture produce. But the tree itself is not agriculture produce. Tree is just an intermediary asset which is giving you fruits. On that intermediary asset, we actually apply IAS 16, property, plant, and equipment. Okay. After harvesting, on your agriculture produce at the time of harvesting, we apply IAS 41, but after harvesting, harvested cotton is your inventory. So students, dairy cattle is simply a biological asset. I'll apply IAS 41. Fruit trees are bearer plants. On bearer plants, actually we apply IAS 16. After harvesting, that harvested cotton is your inventory, and I'll apply IAS 2. Okay. What is the income tax expense in the statement of P&L for the year ended 31st March X5? IAS 12, income taxes. Sigma company of financial year ends on March X5. The following information is available. And they are asking income tax expense that goes to P&L, okay? The estimated income tax charge on the year end is 250, that will go to P&L. Over provision, now student, listen to me carefully. Over provision of income tax will reduce the income tax expense of the current year, and in case of under provision, increases your income tax expense. So we have got over provision relating to the previous year, So I'll deduct this from 250. 15,000 will be deducted. Over provision reduces your income tax expense of the current year. 1st April X5, the statement of financial position showed deferred tax liability 40,000 relating to the accelerated tax depreciation, means tax depreciation was more on the building. But simply 40,000 is your opening liability. Now listen to me carefully, student. We are working for X5, not for X4. First, we need to calculate the closing deferred tax liability for X5. Then closing liability minus opening liability. Difference. If your liability increases, then your income tax expense will increase. If your liability reduces, then income tax expense will reduce. Simply, if the deferred tax liability closing is more than opening, difference will be your deferred tax expense. If your closing deferred tax liability is lower than opening, then difference will be your deferred tax income. And deferred tax income will reduce your income tax expense. The building carrying amount, March X5, they are giving us the carrying amount 8 lakh. They are giving us tax base 600,000. I am having a difference of 200,000 taxable temporary difference. If you recall, students, in case of assets, when carrying amount is more than tax base, the difference is taxable temporary difference, and taxable temporary difference multiplied by tax rate results in a deferred tax liability. If in case of assets carrying amount is less, tax base is more, the difference is deductible temporary difference. Deductible temporary difference multiplied by tax rate gives you deferred tax asset, and this relationship is exactly opposite for the liabilities. This relationship is exactly opposite for the liabilities. 200,000 tax rate is 30%. Just a minute. So closing liability is 60,000. Closing deferred tax liability, and the opening is 40. Let's deduct opening deferred tax liability 40,000. So there is a deferred tax expense of 20. Deferred tax expense, and this 20 will increase your income tax expense. So logically it is 2 lakh 50 minus the over provision, add deferred tax expense. So I'm getting 255. Let's see, do we have any choice or no? Oh, we have to select. Obviously, when you'll be selecting, definitely you will get 255. Okay. In accordance with IAS 38 intangible asset, which of the following cost should be recognized as an asset in the statement of financial position company? IAS 38, which deals with intangible asset, and there are two types of intangible asset. One is purchase intangible asset, and another is internally generated intangible asset. Normally, purchase intangible asset meets the recognition criteria, so we'll be recognizing it. But in case of internally generated intangible asset, when all the conditions are met of the development phase, then we will capitalize the internally generated intangible asset. Otherwise, we will not capitalize. In accordance with the IAS 38 intangible asset, which of the following costs should be recognized as an asset in the statement of financial position? 2.5 million is spent on investing chemical properties of the, this is pure research, you have to expense out. So that is false, I cannot capitalize. 3 million paid to acquire a license from the government to operate a telecommunication network for the next 10 years. True, I will capitalize. I am making payment to get a license from the government, and I'll be having that license for 10 years. So obviously, I'm going to capitalize. 800,000 is spent on modifying accounting software that was internally developed 2 years ago. So students, this is false. You cannot capitalize. You are already having a internally generated. You are saying 850 spent on modifying accounting software that was internally developed. When did you develop? 2 years ago. So actually, when you are spending money on your internally generated assets, so simply that does not meet the criteria because you have not given us that information that first there was a research phase, then development phase, that development phase criteria was met, then we capitalized something. You are just saying we spend 850 on modifying the accounting software. So modifying the accounting software on internally generated asset, intangible asset, you are spending that much amount, expense out. So what is the true one? Only one. The statement 2 is only correct. Okay. According to IFRS 18 presentation and disclosure. Students, my entire lecture on IFRS 18 is also available on YouTube. You must watch that. Must means must. According to IFRS 18 presentation and disclosure, because IFRS 18 has replaced IAS 1. IFRS 18 presentation and disclosure in financial statement, which one of the following items should be classified in the financial statement category in the statement of P&L? Basically, after I would say development and application of IFRS 18, it has affected the most to the P&L. Now you will be preparing P&L under 5 categories. There will be 5 main headings or 5 main sections. Like there will be operating category, investing category, financing category, taxation category, income tax category, and discontinued operations. According to IFRS 18 presentation and disclosure in the financing, which one of the following items should be classified in finance? What comes in the financing category? Okay. The initial expense recognized upon creating a provision for a court case is not a financing category. Discount received on early settlement again is not a financing category. A loss on early repayment. Look at this. When my company is taking a loan, it's a financing activity. If I repay the loan earlier than the requirement, then obviously I'll be bearing a loss. That goes to financing activities. The release of deferred government grant again is not a financing activity. So students, let me repeat. After IFRS 18, number one, IAS 1 has been replaced by IFRS 18. Now, after IFRS 18 has affected, I would say, the most to the P&L. You will be preparing 5 categories. There will be 5 headings, 5 categories. One is operating category, another is investing category, financing category, income tax category, and discontinued operations. So you should be very, very good that if financing category means something which relates to raising of finance. Look at this, the first one, initial expense recognized upon creating a provision for I'm not raising any finance here. Discount received on early settlement of trade payable. Again, I'm not raising finance here. The release of deferred government grant of income. Again, I'm not raising finance here. They're saying release of deferred government grant to income. Slowly and gradually, you are transferring your government grant to the P&L. So when slowly and gradually I'm transferring my government grant to the P&L, again, it's not a financing category. Only the C, Charlie. Okay. Now you should listen to me carefully. In today's class, we have discussed pre-scene mock, March 26 FR section A, but we just did not discuss the question. I have tried my best to give you the relevant review, you can say, or a kind of a revision also. Now listen the announcement carefully. Tomorrow we'll be having a class on section B, but I really want all of my students first try to attempt section B of FR pre-scene mock. It would be better first you have attempted, then the same thing we'll be discussing in the class, then that will give you, I would say, it will give you more benefit. Okay, you can get exactly what fruit you need to get from this ACCA pre-scene mock. First you attempt, then obviously come to the class. Tomorrow I'll be discussing ACCA FR pre-scene mock section B. Timings, everything will be mentioned by the admin. I think within half an hour of today's class, they will mention the timings. And after section B, then I'll be discussing the section C. I'll keep the live class for the section C as well. Of course, the section A of FR pre-scene mock March 26th, that goes to the YouTube channel of Abili School of Accountancy as well. But section B and C, I'll be conducting the live online class, but those classes will be only for my enrolled students, and only section B and C, they will be uploaded only on the portal. So just the, I would say, enrolled student will be able to get the benefit. Plus, those who are watching on YouTube, you know that in FR, we do not only provide detailed notes, we do provide short notes as well. And those short notes, they really help you how to even revise the entire FR within 3 to 4 hours. So students, that is all about today's class on section A, FR pre-scene mock March 26. I hope you people have enjoyed, and I tried my best to give you the main concepts relating to the questions, of course. So thank you very much.